Understanding kickbacks, what they are and how they impact business practices. Kickbacks represent a significant challenge across various industries, often intertwining with corruption and ethical misconduct. Understanding their definition, workings, and implications can help organizations maintain integrity while fostering a culture of accountability. What is a kickback? A kickback is an illicit payment made to encourage preferential treatment or to ensure that a particular service or benefit is delivered inappropriately. This payment could manifest in various forms, such as money, gifts, favors, or any other items of value. The practice is inherently corrupt, compromising an individual's ability to make impartial decisions, whether in the public or private sector. Kickbacks are often categorized as a form of bribery, which is a criminal offense. Key takeaways. Definition and purpose. A kickback is an illegal payment made for preferential treatment or improper services. Forms and collusion. They can take multiple forms but generally involve a degree of collusion between two parties. Impact on decision-making. Engaging in kickbacks hampers fair decision-making processes within organizations and governmental entities. How kickbacks operate. Kickbacks thrive on collusion between involved parties. For instance, a bookkeeper might approve inflated invoices, receiving a portion of the excess amount as a kickback from the supplier. This arrangement not only skews financial data but also establishes a conflict of interest where the bookkeeper is incentivized to overlook the inflated cost. Examples of kickback schemes. 1. Government contracts. A procurement officer may agree to favor a particular contractor for a government infrastructure project in exchange for a kickback. This practice compromises the integrity of the bidding process, jeopardizing the quality and effectiveness of public projects. 2. Sales and purchasing processes. In another scenario, kickbacks may take the form of guarantees of compensation to a purchasing agent who favors certain vendors over others, often leading to inflated costs for consumers and unrealistic market conditions. Warning signs of kickbacks. Identifying potential kickback schemes is crucial for organizations to mitigate risks associated with corruption. Here are some compelling warning signs. Absence of competitive bidding. An open bidding process is crucial in ensuring fairness. Lack of it raises suspicion. Unjustified price increases. Prices that consistently exceed market averages may indicate a kickback arrangement. Close vendor relationships. Personal connections between employees and vendors can hint at potential conflicts of interest. Pressure to use specific vendors. Management exertion on employees to favor particular vendors can unravel underlying corruption. The broader implications of kickbacks. Kickbacks not only affect individual businesses but also damage entire industries and economies. They artificially inflate costs, leading to higher prices for consumers and eroded trust in public services. Moreover, countries characterized by rampant corruption often witness pervasive kickback schemes, making it difficult for honest companies to compete for contracts. Global standards and legal implications. Governments have instituted laws like the U.S. Foreign Corrupt Practices Act to combat bribery and kickbacks. This legislation establishes that bribing foreign officials is illegal, reinforcing the importance of ethical conduct in business dealings, especially in international markets. Anti-Kickback Statute, AKS. In healthcare, the Anti-Kickback Statute prohibits providers from receiving any form of compensation for referrals related to Medicare or Medicaid services. This law aims to prevent ethical breaches in patient care, ensuring that decisions about medical services are made based on patient needs rather than financial incentives. Kickbacks in real estate. While not limited to any one industry, kickbacks commonly appear in real estate transactions, particularly through referrals to homebuyers for services like inspections or escrow. The Real Estate Settlement Procedures Act, RESPA, seeks to eliminate such practices in federally related mortgage loans. Distinguishing between kickbacks and referral fees. It is essential to differentiate between kickbacks and referral fees as both terms can easily be conflated. In some states, referral fees between licensed real estate professionals are permissible, provided they do not exceed 25% of the commissions and are compliant with state regulations. Conversely, payments from real estate professionals to service providers intending to influence service delivery become illegal kickbacks. Conclusion: kickbacks undermine the foundational principles of fairness and integrity in business and public service. Understanding the nuances of kickbacks enables organizations and individuals to recognize, reject, and report such unethical practices. By fostering transparency and accountability, it is possible to create a business environment that thrives on merit rather than corruption. Always remain vigilant about warning signs and ensure compliance with relevant laws to protect both professional integrity and public trust.